Hi everyone, my name is Joe Carrabba. That's Monique Carrabba of the Carrabba Group. We just want to thank you all for coming. This is our first real estate investor speaker series that we plan on starting. You know, the genesis of this was we felt like people needed information, and the best way to get information to people is bring in the experts that know what they're talking about. And so we have Paul Spring, who's going to be talking about 1031 exchanges and other investment options, and then Jonathan Durante from Flagstar Bank, who is an amazing lender.
John Paul Spring Esquire is the president of Exchange Resources, which specializes in 1031 exchanges. And basically a meeting with Phil Ashwine, who couldn't make it this evening, started this event when he spoke to a large group of people, and we realized the passion that people have about the subject. So we're very grateful to have you here, and thank you for coming.
You're welcome. So I've been asked to speak about 1031 exchanges tonight. Thank you for coming. Happy holidays. We appreciate Joe and Monique inviting us.
And phone's off, by the way.
Good. How many of you have ever been involved in a 1031 exchange? So a couple of you have. 3 have you. That's good. How was your experience? Was it good, bad, ugly? It was okay?
Was one of my clients that did it. I had 2 clients that did that, and I believe Phil had one, is the whatever, the guy on that accommodator.
I'm sorry, I'm sorry Phil's not here. He came down yesterday with a really bad case of vertigo, and he kind of struggles with that off and on, but it was just terrible. So I drove up from San Diego today to be with you. 1031 exchanges, they've been around for a long time. My history was I got my start working for a title company, Safeco Title, back in the old days, which was acquired by Chicago Title. And when Chicago took it over, 1031 exchanges existed, but they weren't terribly popular because the IRS hadn't given us guidelines, regulations as to really how to do a 1031 exchange. There was case law, there was regulation, but nothing specific as to how you do it. And so we did exchanges. We really didn't know what we were doing back then, but a lot of people do it. Now, 1031 exchanges have been around for about 100 years, in one form or another. They started in this country because Congress wanted to help farmers be able to sell their property and exchange into more land. You know, farmers, they like to get as much land as possible, and so a 1031 exchange enabled them to do that, and do it rather quickly, you know, which was kind of interesting. Soon thereafter, Congress realized how popular this had become, and so they opened it up to the general public to do exchanges. Back then, you had to do an exchange on the same day. They were all simultaneous exchange, concurrent exchanges, and now we have the deferred exchange, which allows people to kind of take their time, as you know, those of you who've been involved in exchange, to do it. Okay, so to begin with, you know, why do people do 1031 exchanges? We know, you know, the tax reason that you get to defer the taxes for a later time. A lot of people refer to these as tax-free exchanges. They are not tax-free, they're tax-deferred. So you can do exchanges throughout your entire lifetime, and at the end, if you sell your property at that juncture, you're going to have to pay the capital gains tax, all right? So they're not tax-free, they're tax-deferred, but it's a wonderful thing, and especially for families, for parents who want to pass their estate on to their children. If they do that through a will or through a trust, then the kids will get the property in a stepped-up basis, okay? And so if they sold it the next day, they wouldn't have to pay capital gains on it. Did you know that? You know, the whole step up in basis?
So when it goes into the family, the kids, there's
Yes.
there's no tax on it.
Right, there's no capital gains. The kids will get the property with a cost basis as of the date of death. So you would get an appraisal of the property, you know, so maybe the adjusted cost basis was $100,000, and now the property is worth $2 million. So the kids would get it at a cost basis of $2 million, at a base of $2 million, okay? Based upon the death of the individual. So that's the benefit of doing a 1031 exchange. It not only defers the capital gains, but also the recapture of depreciation that we'll talk about maybe a little bit later. But the real reason why people do exchanges is, and what we see in today's world, is that, first of all, people move and they want to take their investment property with them. You know, we've seen somewhat of an exodus out of California of people, and these individuals might own investment property, and so they want to take it with them. So they move to Florida, you know, and they own investment property here in Los Angeles, and so they sell it, they exchange it into something in Florida. That's a big reason why people do exchanges today. Another reason is that people, you know, they don't want to be landlords anymore. And so they sell their apartment complex, and they might buy a commercial building, an industrial building, to deal with just one tenant, storage units. Another big reason why people do exchanges. But probably the biggest reason why people do exchanges is that it allows people to augment their wealth. It increases their wealth by doing exchanges. Because most people, when they exchange up, okay? So they sell their $1 million investment property, and they turn around and they buy something for $1.5 million. And so it increases their wealth by doing that. Does that make sense?
Yep.
So they're buying something of more value, probably collecting more rent, appreciation. They leverage the mortgage that they're going to put on the property. And so it does increase their wealth by doing the 1031 exchange. Okay? Yes?
Can you go exchange from a two-unit building to a single family? And
Yes.
that's part of the.
You can do any combination that you want, as long as the property is real estate. It's got to be real estate, and you have to hold it for investment purposes. Okay? So you can't do a 1031 exchange with your primary residence. You can't do an exchange with, let's say, your second home or a vacation home, unless you rent it out at a certain period of time throughout the year, okay? Then you can. So it has to be held for investment purposes, okay? So people do exchanges, and what, like I said, one of the reasons is that they no longer want to own a particular kind of property, and so you can go however you want. You can go from a single family dwelling to an apartment complex, to an industrial, to commercial, to vacant land. And you can hold vacant land for investment purposes, and people do that all the time. You can, and I think Monique's going to talk about DSTs later on. You can go into oil and gas leases, royalty interests, water interests, as long as where that is located in the state, and the state considers it real estate. Okay? So there's a lot of options that people can do with 1031 exchanges. Okay? Yes?
Monique Carrabba asking a question. My question is, how, with a vacation property, how long do you need to rent out that property per year to use it as a 1031 exchange property?
At least during the 2-year period, you have to rent it out at least 20% of the time. Okay?
That's reasonable.
And that's really not, that's not terrible.
And if anyone else has any questions, feel free to announce your name also.
Yeah. So yes, you can convert it to investment property, and you could also use it for your personal use. Okay. So the combination can be anything that you want. And you can sell as many properties as you want and buy one property, two properties. It depends. A lot of it's just logistics and the timing of the exchange. Okay. All right. You've probably heard about the time limitations on a 1031 exchange. When an individual, a taxpayer, an investor sells their property, they close escrow, and they're going to do a 1031 exchange, they have to identify what property they're going to go into within 45 days. Okay, that's really critical. There's no exceptions unless we have a natural disaster, which we've had recently, even in the state of California. But typically it's 45 days that you have to identify. And that's 45 days. It's if the 45th day falls on the weekend, that Sunday is the 45th day and you have to identify. You don't get till the next day. So you have to identify. Now, that doesn't mean that you can identify as many properties as you want, as we were able to do in the olden days. There are basically two rules of identification. You can identify up to 3 properties, during that 45 days. It has to be in writing, and you'll send it to the exchange company. Okay, so that's really important. And it's a sending. You've got to send it prior to the 45 days. So it doesn't matter what the value of those properties are, but you're limited to 3 properties. Does that make sense? And it's probably the rule that most people use more than anything else. 3 property rule. The second rule it's called the 200% rule. And you can identify as many properties as you want during the 45 days. And you have to list in writing what those properties are. You have to be explicit what they are. And then you have to give a value for all those properties. And when you add up the values of all of these properties, let's say you list 10 of them, the total value cannot exceed twice the value of the property that you sold. Okay, does that make sense? That's the 200% rule. People use that when they have to buy a bunch of lots in a subdivision, and they're individually owned, and so they have to use the 200% rule. But here again, you have to deliver it within the 45 days. Okay. Any questions about that? Yes.
You don't have to have purchased that other place. You just have to identify.
It's
Okay.
Marianne.
It's Marianne O'Donnell. Hi, everybody. You just have to identify it and indicate what it is or what the.
That's all you're doing during the identification is identifying these properties.
Okay.
They don't even have to be for sale. They don't have to be. You don't have to be in contract with them. All you're doing is identifying. Okay. Now, from a practical standpoint, you're going to make sure that you've contacted the seller and that you're probably in contract to buy. Because the time periods are just really short.
Yeah, hi, Judith Rubens. If you identify 3 and you change your mind, can you rescind identification? Is that acceptable?
Yes.
Rescind identification.
But you have to do it within the 45
Yeah,
days.
of course, everything has to be
Yeah, within 45
But you
days.
can rescind the identification.
You can, if you
decide-
identify,
You can identify 3 and then rescind the identification and go again.
yeah, you
As long
can
as you're
rescind
timeline.
one of the properties, 2 of the properties, 3, it doesn't make any difference. And then you do that in writing, and then you send in a new identification. Yeah.
Monique Carrabba again. So mine is twofold. One you might be getting to is a reverse exchange. The other thing a lot of people have talked about is purchasing a single family home and then adding an ADU where it's literally built out, I guess, by the end of a certain time frame.
Yes.
And I know that Exchange Resources has a division for that type of process, but
That
I'm
is
curious
correct.
on the reverse exchange and
Yeah.
also the value added in construction during the 1031 exchange.
Right. And we'll talk about that in a few minutes. So, but we're talking about your straightforward deferred exchange. And these are the ones that most people use, okay? They're the most popular without question. Before we go on, okay, so you've identified within the 45 days. The 45th day starts the day after you close escrow. There's also another time period that starts the day after the close of escrow, and that's the 180 days. So within 180 days, you have to close on one or more of those properties that you identified, okay? And all you have is 180 days. Yes?
Good afternoon, everybody, and happy holiday. This is Zori with KW Beverly Hills. Then you have to close one of them. Let's say 3 property for 2 million, just saying that. One of them is 700,000, you close the first one. What is the other 2? What's the maximum limit time you have to close the other 2 to order to come to the 2 million?
You have to close them all within 180 days. Yes,
Thank you.
yeah, exactly. And so when somebody asks the question, can I sell 3, 4, 5 properties and buy 6 properties at the other end? You can do that, but logistically, it's very, very difficult because of the timetable, okay? All right, so that's the straightforward exchange. Let's talk about the financial aspect of it, okay? And people get confused about this all the time. When you sell property, generally what happens is that you're walking away with equity, your cash, right? Your net equity. And you're also being relieved of debt. So if you're selling that $1 million property, there's $700,000 in equity, and you have a $300,000 mortgage on it, when you buy the replacement property in your 1031 exchange, we always say that you have to exchange of equal or greater value. But the truth is, you have to take on as much debt as you were relieved of. So if you walked away from a $300,000 mortgage, you have to take on at least a $300,000 mortgage on the new property. And you've got to put all of the cash coming out of the sale of your property into the replacement property. Okay, does that make sense?
Yep.
But the question is that how do you replace that debt? Well, I just mentioned you can take on a new mortgage, right, on the new property. You can formally assume a debt that already exists on that replacement property, okay? Or you can bring all new cash into the deal and pay all cash for the replacement property, okay? So you have that option. The reverse is not true though, that you can't take a larger mortgage out and keep some of the cash that came out of the sale of your property. And people try doing that all the time. You know, they say, okay, I have $800,000 in cash and equity that came out. I'll take a bigger loan because I want to take a trip around the world with the $100,000. Well, you can do that, but you're going to pay taxes, and you'll probably go coach. So just that's the financial element of the 1031 exchange. Just keep in mind you've got to exchange of equal or greater value. And a lot of people will say the only thing I have to exchange is the cash, is the equity. And that's not true. Okay?
Maybe this is jumping ahead, but so what's been the recent appetite for 1031 exchanges with rising interest rates?
With the market that we have right now?
Sorry, Danielle, but I don't know if everyone heard my question.
No,
Hi, Danielle.
Okay. I always, can you hear me now?
Yep.
Yes, I always think I'm so loud, but I'm not. I was just saying, I don't want to jump ahead. I don't know if you're going to talk about this, but just given that you have to assume the same amount of debt on the new property, what has been the appetite for 1031 exchanges with rising rates?
Oh, you know, with mortgage rates the way that they are,
Because assumingly someone's exiting a property that they had 5, 10, 15
Yeah.
years ago with much lower interest
And their mortgage rate is a lot lower, it could be
Yeah.
3%, 4%, now they're looking at 7.5 or whatever. It certainly has dampened those people from even selling their investment property, you know, because they say, well, okay, unless there's an urgency and a real reason why they want to do a 1031 exchange, they're gonna hold on to their property, and I think that's what we're seeing now. There's still a lot of cash out there. And I would say with our business, when the interest rates went really low back in March of 2020, when the Fed decreased it down to 0, 220 and even into 2021, 2022, the market was red hot. I mean, we were doing on an average of about 600 new exchanges every month.
Wow.
You know, that's a really big volume, think about it. Now it's settled down, it's more like 200, 250. And so there's a lot that goes into it, certainly the mortgage, the rates and stuff, but the inventory out there is pretty low, especially, let's say, in Southern California. Yeah. So it has put sort of a stranglehold on things. All right, so that's the straightforward 1031 exchange. That's what people do. You have to make sure that when you have a contract or an escrow, that there's language within the contract that allows the taxpayer to do a 1031 exchange. And the reason for that is that the exchange company is going to require the buyer or the seller to sign documents, allowing that seller on the first leg to do a 1031 exchange. So having that clause in there is very important. In the days when prices were escalating every 30 minutes, remember those days? And a lot of times if that clause wasn't in there, the seller could say to the buyer doing the exchange, oh, okay, I'll sell you this property, but it's gonna cost you $100,000 more, okay? So you wanna make sure that clause is always in there, in the contract and in escrow, okay? It's just an accommodation thing. All right, like I said, we've had extensions recently, not only in California, but throughout the country. We had the big extension in Hawaii, for example, because of the fires. And typically what the IRS does is that if FEMA comes in and declares a natural disaster, the IRS will come in and extend deadlines, not only for 1031 exchanges, but as you know, for tax filings. Remember, everybody got until November 16th, to file. And so that, that became extremely important. And it caused a lot of problems because he had to take into consideration who was an affected taxpayer and who wasn't, by the natural disaster, okay? One other thing, in the olden days, you could do a 1031 exchange by selling property domestically in the United States, and you could exchange into a foreign country. Did you know that? Yeah, that was allowed. You can't do that anymore. It has to be domestic for domestic or foreign for foreign. So if you own property, if you own that chateau investment over in France, you can certainly do a 1031 exchange into Spain or someplace like that. But you can't bring that money back into the United States. And the reason why they changed that law is that the depreciation laws are different outside of the United States versus here. And so to keep the playing field equal, they said no more, okay? Okay, we're gonna talk about cost basis, yes?
You can do the 1031 exchange from state to state then, in United States or no?
Yes. So like I said, a lot of people are moving their investment property, let's say out of California, they're going to Arizona, Texas, Nevada, Arkansas, they're just going everywhere. And and properties are coming in too. I would have to say that the exchanges that we do here in California, we do exchanges all over the country. If somebody's selling in California, typically they're also buying in California, okay? That's what typically they do. Okay, when you're doing a 1031 exchange, you need to know what your capital gains is going to be. And how you figure that is by determining what your adjusted cost basis is in that property, right? Your adjusted cost basis is, first of all, what you paid for it. Secondly, any improvements, capital improvements that you made to the property, you add to that basis. So let's say you remodel the kitchen or the bathroom, and it costs you $50,000. That $50,000 goes to the basis, right? So if you bought the house for $250 and you put $50,000 into it, your basis now is $300,000. Depreciation, what do you do with it? Do you have to depreciate this investment property? Yes, you have no choice. The IRS demands that you depreciate. And so if you own a single family dwelling, how do you determine to depreciate that? It's on a straight line schedule, right? 27.5 years. So you figure out what the improvement is worth, you divide it by 27.5, and that's what you take as the depreciation. For commercial property, it's 39 years. So when you sell the property, you have to take a look at how much depreciation you've taken. Because if you just sell the property, pay your capital gains, what do you have to do with the depreciation? You got to pay back 25% of it. Okay? 25% time of the sale, you got to pay it back. So that's the adjusted cost basis. So whatever that is, and whatever you get for the property, the difference is your gain. And that's what you have to pay taxes on. Yes?
Does it need to be documented, the improvements that you made? Do you have to have it all in like receipts for improvements you've made on the property over the years?
Yes, and your CPA will keep track of that.
And if you don't have those, let's say you kind of did things over a span of time, you can't then add that as
you probably can, and I would suggest you probably talk to the contractor, you know, get an estimate as to what it costs, and go with that. And if it's not, you know, the IRS, the Franchise Tax Board, could come in and take a look at the property and say, oh, you know, you spent $500,000 on this, you know, this little bathroom, and they could say, no, that's not right, you know, type thing. So I think, you know, whatever you can get, and just keep that correct. But your CPA will keep track of a lot of that.
So you want your CPA involved in your 1031 exchange?
Oh, absolutely.
Okay.
You know, almost every time we put a call into the CPA, because people try to do things that they really shouldn't, like selling a vacation home, or you know, their kid's going to college somewhere, and they bought a condo and the kid is living there, and they've never been there, the parents have never lived there, but they can't do a 1031 exchange. Well, we always recommend that they talk to their CPA, because the CPA has to file a tax return, and they have to file an 8824 form with the IRS indicating that these people did a 1031 exchange. And if the CPA doesn't agree with it, then they're kind of out. All right? Yes?
Closing costs. When you sell the property, there is commission you have to pay, there's closing costs, I'm sorry, for borrowing, but yeah, so you deduct it from?
Yes. So you're always looking at the net amount, and the net amount is your non-recurring closing costs. The things that you just have to pay once, like your commissions, your escrow fees, your title fees, our fee, for example. Anything that is a one-shot deal, you can subtract that from the total amount, and you don't have to replace it. Just keep in mind, what you have to replace is the net amount. That's a good point. Okay? All right. So we know you have to exchange domestic for domestic, foreign for foreign. What your adjusted cost basis is, it determines your capital gain for the IRS. Does the IRS and the Franchise Tax Board audit any of these exchanges? What do you think?
Yes.
Yes, very good. Yeah, the answer is yes.
Religiously.
Religiously.
One would think so.
And especially the Franchise Tax Board in California. They right now are extremely active in auditing these these files, okay? All right, Monique brought up a situation where sometimes people find replacement property and it's too good to pass off. And so they want to buy that first before they sell their property, okay? Does that make sense? Have you ever heard of that?
Yes.
And it's called a reverse exchange, a reverse 1031 exchange. It's allowed by the IRS, it's allowed by the Franchise Tax Board, and essentially the time periods are the same. So once you acquire that replacement property, we'll talk a little bit about how you do that. You have 45 days in which to identify what do you think? What you're gonna sell, that's right. And the rules are the same. You have the 3 property rule, you have the 200% rule. The rules are the same. You have 45 days to identify, and then you have 180 days to do what?
Close.
To close on one of those relinquished properties, exactly. The big difference with the reverse exchange, though, is that the IRS has said that the taxpayer cannot own both properties at the same time. So what we do is that we set up either an LLC, which we'll talk about, and or a S corporation to hold title to that property. It's a separate entity. Nobody else has any other property in this entity. And so we will hold title to the replacement property during the course of the exchange. Once the property has been sold, the sale property, then we will turn around and deed this replacement property to the taxpayer to complete the exchange. Okay? See how that works?
Yep.
It's a lot more complicated than that, but essentially, and so the exchange company can hold title to either the replacement property or the relinquished property, okay? So before they acquire the replacement property, we'll take title to the sale property. Yes?
If you find, as a buyer, if you find a property and that seller is doing a reverse exchange, you basically found a seller who has to sell.
Yeah.
And you kind of have them over a barrel, because if they don't sell, they're going to pay the piper with the taxes.
Yeah, if they're reaching the end of their time period and they have to sell that property, and that's the property that you want to purchase, yeah, they're under a time gun, right?
And that seller would have to put language in the contract alerting the buyer to the 1031 exchange.
That
On the reverse
yes,
side.
on the reverse,
Okay.
that they have to close within a certain period of time. Yeah. All right, so that's the reverse exchange. They're a lot more costly than a straightforward exchange, but there's just a lot involved. The creation of the entity that we take title to, we have to file a tax return on that entity, and so it's just a lot more expensive. The other exchange that Monique mentioned was a build-to-suit or construction exchange. Have you ever heard of that?
No.
It's where you identify within the 45 days a piece of property that you want to acquire. But you're gonna have money left over from the sale of your property to do improvements to that property, okay? It could be any capital improvement. It could be a separate unit in the backyard. So that money will be used to build those improvements, okay? So on the identification sheet, you've got to list what property you're buying, and then you have to list what this thing is going to look like once it's completed. So if you have designs, architectural plans, whatever, you will submit that with your identification indicating what it will be and the cost of it, okay? So here again, as the exchange company, at the close of escrow on the replacement property, we have to take title to that. So we take title to it, and then we do the construction. We don't do it ourselves, but we're holding the funds. Everything is approved by the taxpayer. We pay the bills, and hopefully by the 180 days, what happens? The construction has been completed, or the money has been all used up for improvements on the property, okay? And if at the end of the day, for example, there's money left over, you can't go to Home Depot or Lowe's and buy a bunch of 2x4s and sheetrock and dump them on the property because it's not what? It's not attached, it's not affixed to the property, and therefore it's not real estate, okay? So bill-to-suit exchanges are popular, maybe even more popular than reverse exchanges, but here again, they're expensive, and you just really have to know what you're doing and get everything in line in order to get the property improved, okay? Yes?
What if not?
The what?
What if you don't finish?
If you don't finish, for example, then you probably are ending up doing a partial exchange. So let's say you sell for $1 million, you buy a piece of property for $600,000. You want to use up $400,000 in improvements. And by the 180th day, you've only used up 300 of that. You have 100,000 left over. You will pay taxes on that 100,000. And it's something that we call a partial exchange.
No extensions?
Excuse me?
No, not possible to get extension.
Extensions.
There are no extensions. And the reason why is that the 1031 exchange is codified in the IRS code. And in order to get an extension, you'd have to have congressional approval. And you know how difficult that
Not
would be.
happening.
Yeah, that ain't happening. Okay? Lastly, I just want to say, taxpayers. The taxpayer that sells the property has to be the same taxpayer that buys. And this is a struggle for a lot of people. So if you're an LLC with a partner, you and I are members of this LLC, we decide to sell, that LLC has to be the one that purchases. You and I can't go our separate ways. Okay, does that make sense? Because it's the LLC that's the taxpayer that is held this for investment purposes, not us as individuals. Okay, the same rules applies for partnerships. If you have partnerships with the 5 of us, the partnership has to buy the replacement property because it has its own tax ID number. Okay.
Right.
There's something that's called a drop and swap, where you drop the property out and then you swap it. And the IRS, they kind of go back and forth on that, whether they will allow it. The Franchise Tax Board has said absolutely not. It has to be the same taxpayer. Yes?
I've worked with house flippers, Monique Carrabba again, and many of them have bought a house for 6 months to a year, rehabbed it, and then try to throw in a renter in there, and then do a 1031 into another flip. So my question is, when is that possible, and how long does someone need to rent the property out before they can 1031?
Yeah, that's an excellent question. And that comes up all the time. People have lived in this house, they move out, they get a renter, they come in,
Yeah.
and then then they want to do a 1031
Yeah.
exchange. The general rule is you have to hold it for at least 2 years, okay, as an investment property. Does that make sense?
Yeah.
Now, what Monique is talking about is really a flipper, right?
Yes, correct.
When the IRS came out with the rules, they had exceptions of things that you can never do a 1031 exchange with. For example, stocks and bonds. You can't do an exchange with 1031 exchange with that stuff. You can't do a 1031 exchange with mortgages and deeds of trust. You can't do a 1031 exchange, and it's very explicit, with inventory. And that's where the flippers would come under, because they're holding property not to hold it for investment purposes, but for inventory to sell it. Okay? And so you can't do it. So they need to hold on to it for at least 2 years before they go ahead and they sell it.
And then how long does that rental income need to be part of those 2 years?
That's a good question. A lot of CPAs would say at least 1 tax year. We want to see it. I think most CPAs would say we want to see it on 2 tax returns.
But maybe 3 months in a year qualifies as a 1-year tax return?
You mean if you've turned it
If you
for
rented it for
3
3
months,
months
and then
and had it for 2 years?
and then 5 months later you sell it?
Yeah,
No,
okay.
no, the IRS will say no.
I've
And
been
especially-
asked, be creative, Monique.
Yeah,
Yeah.
yeah, we get asked that all the time, but you've got to hold it for investment purposes. And when you buy property, it has to be your intent forevermore to hold on to that property for investment purposes. You know, intent to the IRS is extremely important. You're going to hold on to it for investment. Okay?
You can't exchange it to something, have it as a rental property for a couple of years, and then use it as as a primary residence?
As your primary residence, you can.
Okay,
Yes, you can.
you can do that.
Yeah. And you know, the rule for the 121 exclusion is, as long as you've lived there and used it 2 out of the last 5 years, this house, you can take advantage of the universal exclusion, right? And for a married couple filing a joint tax return, you get what?
500.
You get 500. For a single person, you get 250. Okay, so if you live there 2 out of the last 5 years, you can do it. But let's say, for example, this one just came up yesterday. These people bought this house 5 years ago, and they moved in, they lived there for like 2.5 years, and then they moved out and made it a rental. And the question they had was, can we take advantage of the 1031 exchange, and can we take advantage of the universal exclusion? And the answer is,
How come you can't do both?
you can do both.
You can do both.
Yeah, because you met the guideline of 2 out of the last 5 years for your primary residence. Doesn't matter when those 5 years, those 2 years are. And then presently, it's investment property, and you can go ahead and do it.
So you get both of those shelters.
Yeah, and a lot of people will combine those 2 code sections in order to take advantage, to really take it, because the universal exclusion is tax-free. You'll never pay taxes on that, okay? We had something interesting come up where they bought this house 5 years ago. They lived in there for 2.5 years, for the next 2.5 years, whatever. It's investment property. During that period of time, they rented a condo, and now they want to sell both properties and take advantage of the universal exclusion on both. Because apparently the condo doesn't have, maybe has 250,000 worth of gain, and the other one has maybe 400,000. Can you split it as a couple? No, you cannot.
No, it doesn't seem like you could, because one is your primary residence. I mean, it's,
Yeah, both of them were their primary residence, but you can only do this once every 2 years, okay? So they would have to wait 2 years in order to sell the condo and take advantage of it, all right? What happens, we had a situation where you had a couple, they both owned these houses. One lived on the West Coast, one lived on the East Coast, okay? Usage. Can they sell both?
And get the,
It's split.
And get the 250?
yeah,
250
yeah,
each?
250 each.
Yeah. They can because of the usage element of it. So let's say, you know, the one spouse on the East Coast was using that price. She didn't use the one on the West Coast. And so she has the, whether they file separately or jointly, they can split it. And so she can use the 250 and he can use the 250, okay? Also keep in mind with the 121, both spouses don't have to own it. Typically say, you have to have title to this property, right? Only one spouse has to take title to the property, to the houses, all right? But they both have to use it.
Yeah.
It has to be the primary residence. Yep.
And also because it's a community state, right? So even if they're not entitled. Oh, hi, it's Mary Ann O'Donnell again.
It doesn't matter.
Doesn't matter.
Yeah,
Okay,
doesn't
thank
matter.
you.
But back to the previous example of the house being a 400,000 and the condo being a 250.
Yeah,
If they're, can they just take the 500,000 and then pay tax on
sure.
the rest? Okay, so they could.
Yeah, so on the
technically do it.
400,000, they would take the bigger, you know, gain. and utilize it on that.
But, sorry, but they couldn't take 400 from one and then 100 from
No.
the other. Okay, so they still can't combine to
No.
get to 500.
No, it's just one house at a time,
Got it.
and once every 2 years, yes.
I'm so lucky to have you here because I have so many questions, and this is my last one, I promise.
Promise.
Okay. Scout's promise. Okay, so the biggest thing that I find is that income property. So someone has a one bedroom, they live in part of it. How does the IRS and Franchise Tax Board determine what percentage is the 1031? Is it square footage? Do they split it down the middle? That is always kind of a concern with people that have rentals that they
Yes.
live in, including a lot of 80s that are now gonna be 1031s down the road.
Yeah. Yeah, people rent out a room or two, and the difficulty is appraising what is used by the renter. You're not going to exclude the renter from using the kitchen, let's say the bathroom or the common area, and so you just have to look at percentages. And there are appraisers out there that do this sort of thing. Well, they'll come in and they'll take a look at these properties. The other thing is that you have a home office, and you use a portion of your house, your primary residence, as your office. You could exchange that.
But what if it's just like a straight duplex that's 400 square feet and a primary residence of 1,800 square feet?
Yeah.
How is that divvied up versus part of a house? Like, or a duplex, for example. Different sizes. One owner lives in the larger unit.
Yeah, and so you have a duplex, they've rented out the 400 square foot
Yes.
a unit,
Yes.
and they live in the other. And they're
Correct.
selling the duplex for $10 million.
Yeah.
They would just use percentages, that's all.
Percentages based on square
The
footage?
square footage.
Okay, got it.
Not only square footage, but probably the house where they live in is worth more because of the fixtures and things like that.
Okay, and then
Okay.
get a CPA involved.
Get a CPA and get an appraisal about, or a real estate agent that really knows, their business.
They're all
Yeah.
here.
Yeah,
Well,
you can do it.
anything else you wanna cover?
No.
Okay.
Do you have any questions?
Does anyone have any questions?
I beat you to it.
Wait, did he answer the question about how long you should hold on to a property?
Oh yeah, that was a question. How long if someone gets a 30-year mortgage, they're basically profiting from or getting a tax advantage from having a loan
Sure.
and having mostly interest versus principal being paid off.
Sure.
Is there like a good year point when someone should, like, at what point should they consider selling their home or their investment property?
I've never heard of people considering that, to be honest with you.
Well, Phil Ashwan mentioned that it was
Oh.
12 years on a 30.
That's kind of the break-even point where you might want to
Yeah,
consider selling.
yeah, and maybe John might have.
Yeah, John might know, but yeah, I've
Or
never,
factoring in depreciation too, I guess?
that could be too. But, depreciation goes on for, 27 and a half years, 39 years, so. And sometimes people depreciate the property down to zero.
Yep.
And that's another reason why people do exchanges. They want to start a
Mhm.
new depreciation schedule based on the gain of the property.
Well, I think we've wrapped it up. No more questions. I want to thank Paul Spring from Exchange Resources. I personally, Joe Carrabba, have worked with Exchange Resources since we started in 2005, and they are the best in the business at what they do, and we're so grateful that you came all the way from San Diego
You're
to
welcome.
join our group. And if anyone wants transcripts, the PowerPoints that we'll have or a video link, feel free to email Joe Carrabba or I. And I look forward to introducing our next speaker, Joe.
Oh, you want me? Well, I'm gonna take this.
Yeah, it's all you.
Our next speaker is someone that we've used for many, many years, and we always recommend him as a top-notch lender. He knows what he's doing. He always gets the job done. He is now Senior Vice President of the Private Client Group at Flagstar Bank, which I'm sure he'll discuss is now like establishing a more forceful presence in Southern California. Jonathan Durante.
Joe, can you identify, here we go, PowerPoint.
Hi, everybody. Thank you very much for the kind introduction. The feeling is quite mutual in terms of the love and respect that I have for the Carrabbas. We've worked together on a number of clients. I mean, it's kind of countless at this point with the amount of real estate transactions. So thank you for the opportunity for having me here and being experts in your field, because it's always easy for me to have conversations with clients when I've got great partners involved, and the Carrabbas are a perfect example of that. So I'm here to speak tonight about the state of mortgage lending. I wish I could say I bring good news. I would say I just bring news, as it were. Lots of it, because this week has actually been an interesting one in regard to this topic, because there's a lot going on Capitol Hill, which we'll cover. But yeah, what would the state of mortgage lending be right now? I'd say it's probably a state of disarray, would be the safe thing to say. But that's okay. Everything's a cycle. Time marches on, so we'll continue. But just to give you a little bit of an idea about who I am, I've been in banking for close to 25 years now. Started my career in these are all the cycles. I'll tell you all the big cycles that I've been through. I came into banking right at the tail end of the dot-com burst in 2001. Was there for the Great Recession in 2008. Lots of interesting stories with that. And then everything that we've seen since then, the huge recovery, and now, like everything else, we're cycling again. So been at large banks like Wells Fargo, been at smaller regional banks like One West Bank, if you remember that was here in Beverly Hills. And then for what was hopefully going to be the tail end of my career at First Republic Bank, until unfortunately First Republic Bank got caught up in the March Madness of this year. And now happy to say that I'm with 200 of my closest friends and colleagues over at Flagstar Bank. And Flagstar, to Joe's point, thank you, Monique. And it's been a very nice soft landing because we're excited that we're growing out a private banking arm and trying to fill that void that's been left by everything that transpired earlier in the year with the failure of some of the banks that I mentioned or that I've been a part of. So, and there are other players coming to the field. So that's kind of part of the good news, is that, as we navigate these, I can't say they're uncharted waters, it's just that we haven't been in them for quite some time. So as we navigate these waters, players will reemerge, and some of them will be familiar faces, just under different titles and kind of in different environments. So that's where we find ourselves now. So if we can move to the next one. So what I'm going to cover tonight is the 3 R's that we've seen present in 2023 and 2024. And I mentioned 2024 because I think that we can expect these R's to be quite present in the year coming up. Again, I think towards the tail end I bring some positive news or some optimism. But yes, I think that a lot of what we've seen this year, 2024 is going to be a bit of a rinse and repeat, right? Maybe a gradual ebb and flow into the right direction, but we've still got a ways to go if you take a look at the prevailing economic outlook that we've got in place right now. So the 3 R's are rates, regulations, and reluctance. And I'm going to start with everybody's favorite topic, which is rates, because that's what's near and dear, and for our clients and our buyers and our sellers and folks that are getting in and out of real estate transactions. They want to know what's happening with the rates and how it's going to affect them. So if we take a look about where mortgages have been, I start off by mentioning again the cycles, right? Events tend to occur in cycles. How things started during the recovery from 2008, you can see on the left, and how it's going is Jack Nicholson nursing a pretty hefty hangover there, and that's kind of where we feel ourselves right now. And I think the hangover is going to last for a bit longer, but yeah, it feels quite abrupt, right? And part of it, obviously, there's a lot of psychology involved. But for those of us that can remember 2008, those were very, very hectic times. But they were quickly assuaged by just the massive amount of recovery that happened with the low rate environment. And then we thought that we were going to get to the end of that, right? Come 2019, where people said, okay, we've had our fun. Now it's time to get things back in track. Inflation, I remember having these conversations with clients. Inflation is kind of the elephant in the room that no one's talking about just yet, but the rates started to slowly tick up, and then what do we have? Of course, we had the pandemic, and that required extreme measures, which the Fed took, which initially, personally, I feel, were the right call, because it stimulated a lot of growth and it stimulated another kind of minor recovery from them. But then what happened afterwards? Folks, I think you can argue, and I'll talk about this in a little bit of sleep at the wheel, right? And then we see, that has come home to roost in recent years and months. So let's take a look at, speaking of that journey, I think it's important to see where the 10-year treasury has come, right? And as we can imagine, over the past 5 years, it's pretty much gone in one direction. But it's really important to kind of see, where the lows are to where we are today. So the lowest was really low, right? If we take a look at, August of 2020, which again, only 3 years ago, right? It was, only 50 basis points, right? And last month, or 2 months ago, sorry, since we're in December now, early December, in October, it got really, really high. The highest it's been for quite some time. So on both ends of this spectrum, these are records in a relatively short amount of time. If you take a look at other historical graphs regarding the 10-year treasuries, it is not this abrupt. It is not this abrupt. It's usually much more measured, right? We don't see activity. I mean, even if we're talking about, Paul Volcker, who's, famous for establishing the whole, the Fed monitoring, recessionary trends in general, who was famously quoted as saying, I'll send the country into recession if I have to, and he did. But even then, in that situation, it did not happen as abruptly as what we've seen. Look at how quickly the rates went up with the Fed playing the catch up during that. We're talking about the past year and a half or so. Again, record-breaking rate hikes, and I can tell you, my gut tells me that the easing off the pedal is not going to go as quickly as it went. It's not going to go down as quickly as it went up, right? Because again, you have to figure that these were austerity measures for all intents and purposes. Next slide, please. So, speaking of our friends at the Fed, ignore the wall of text. You can read it over my shoulder if you want, or just go to those articles at the bottom there. But the reason that I have this is to show you an idea of these are two practically different organizations, right? So if you take a look back in 2020, back in September 2020, the Fed was saying that, all right, we're sensitive to inflation at this point, and we understand that it's rising, but we're going to keep within our numbers, and we're expecting some gradual increases that we have to make now in the wake of everything. And I underline the important part. Back in September of 2020, even December of 2021, the Fed said that they expected to raise interest rates in 3 1/4 percentage point moves in 2022. 1/4 percentage, 25 basis points. Well, what really happened, right? What really happened in 2022, we see a lot more. They started raising to the highest level in 15 years. And when they were raising rates, they weren't raising it in these easy 25 basis points increments, right? Started off that way, but then they realized, we're really far behind on this. We have a lot of catching up to do. And so they started really putting the pedal to the metal. So then we started seeing 50 basis point increases. Then we started seeing 75 basis point increases. And every time that they did that, a couple of times in a row, that really, really accelerated things, right? So going back to the point that I was making earlier, to the Paul Volcker days, these were the most aggressive policy moves since the early 1980s, right? And then at this point now in 2022, that's when you hear the Fed finally kind of coming out and saying, we're going to put the target interest rates in the above 5% range, which was mind-blowing when you think about that, right? Because again, if you're kind of doing the math in your head and you're thinking about borrowing and lending, look, banks are for-profit institutions, right? That's just the way that the economy works. So if the Fed's target rate that they're going to lend money to banks at and they're going to charge banks are in the 5% range, well, for the banks to make money, their spread is usually in the 2 to 3% range and above that. And that's where we find ourselves today, right? And talking about current day, now this, actually I sent Joe and Monique the slide last week, and stuff has happened since then, right? Although I can't say it changes too much, which is on here, but the story is kind of the same. If you've been following the news this week, the Fed met. Now, the good news in this story, this ongoing saga, is they haven't had a rate hike the past couple times that they've met. That's good, but you have to read between the line when it comes to the Fed, and this Fed in particular, because remember, we're dealing with two different institutions when you think about it, right? Same economic policy, not really, right? All of a sudden things really shifted. So you have to read between the lines what the Fed's saying. What they're saying right now is that we are keeping the door open for additional rate hikes. And you can be darn well sure they will absolutely do it if they need to. They have really hitched their wagon to this 2% inflation mark. Now, there's some optimism around there. Again, if you're following the numbers, inflation is now around the 2.5% range. So that's good. It's moving in the right direction, right? But not all the economic impact that normally dictates that inflation rate, it's coming together at the same time. It's still somewhat disparate, right? Jobs are good, right? Job growth is great. Again, that's cooled off a little bit, but not a lot. And for that reason, the Fed is going to continue to say that we have the power of the pen and we're going to keep using it if we need to. So the market was pricing in a lot of this, expecting that, oh, well, the Fed hasn't raised rates, so everything's looking good. You have to look at what Powell's saying and what the people around him are saying, right? There's some optimism coming out of that, but I think it's really reasonable to expect another potential rate hike if the prevailing economic conditions do not move in the same direction that the Fed is looking to. And again, it's all about inflation. You want to know what the Fed's thinking and what they're thinking about? It's whatever the inflation rate's at, that's where they're going to be at. They live and die by it. Is that the best measuring tool from an economic perspective? I have my personal opinions about that, but also I'm not a professor of economics. So we kind of stick with what's tried and true and what's worked. It's just that, again, as we find ourselves in these different economic cycles, not everything pans out the same way. Yes, Monique?
At what point, traveling overseas, I see the cost of things are so much lower. At what point do you think we could see that what we saw in the early 80s, where there was eventually deflation?
Well, that's a great question. I mean, in terms of it, there's a few conditions that can have to take place for deflation, right? It has to be a situation where the rates are holding high, but at the same time there's a plethora of everything, right? Right now there's still not that plethora, right? Because we've had some supply chain issues. I mean, look at real estate in general. We'll get to that in a little bit, right? Real estate inventory. You would think that there'd be houses left and right since nobody's selling. Inventory is really hard to come by right now, right? Because it creates this kind of weird cycle of events, which again, we'll get into later. So we're not at the deflationary stage yet, but the concern is if we stay at these interest rates for a prolonged period of time, and if the Fed just keeps banging the drum around, well, inflation, but if it doesn't change and it doesn't move the needle, yes, eventually we can start to see deflationary. And that's a kind of a perfect storm, because now you've got high rates, you've got a lot of stuff, and people aren't necessarily buying it, and if they do buy, they're paying a higher rate for it, right? Which doesn't help anybody. That really, really grinds economic development to a halt. Right now, at least, again, supposedly our GDP is strong, and there is positive activity in that field. If you have a deflationary environment, even that grinds to a halt. So, next slide, please. So, I don't like to say the new normal. I hate that term. So I've gone with required reality. So this is the required reality of rates right now. And we've touched upon this already, right? Economically, things are still looking pretty strong, and they're hot enough, right? Hot enough that the Fed doesn't want to cool off yet. The labor market remains steady at least. And recession, that was the big thing. Recession is supposed to be what tempers the Fed and tells them finally, okay, now we have to start lowering rates, because if we send the country into a recession too quickly, it can have dire circumstances. Well, no one's really worried about recession right now because, again, by the numbers, we're far off from happening, right? Things are still pretty positive in terms of production and output. Now, the challenge with recessions are, whoever you want to talk about, the economists, the media, whoever, they always call them in reverse, right? So when you're in the middle of the recession, you don't technically know it until somebody says, oh, that was a recession. We already had it. We had it, or we're in the middle of it now, we're 2 quarters into it. By the way, the recession started 2 quarters ago. And now here we are. And then maybe the Fed says, okay, we'll take our, we'll start to rescind rates a little bit. But until all of that changes, yeah, that's why I said 2023, 2024, we are expecting, at least in my world, rates to remain at these levels. Now, it's interesting because certain news cycles everybody's looking for some sort of kernel of optimism out of the Fed. You saw, as I mentioned in the previous slide, in October, rates were at their all-time highest, right? But by mid-November, they dropped a whole bunch because, again, there was this optimism around the fact that, well, the Fed has not raised rates a couple of times, so that's good. So it started to send the Treasury yields lower, which was positive for mortgages. So yes, instead of borrowing at 8%, now you're borrowing at 7.25%, 7.5%, right? That's better, not great. Anything in a downward trajectory at this point is the right direction. But again, we're still talking about these historically high rates, at least in recent history, right? out of curiosity, anybody know what the kind of median average for mortgages since kind of the advent of mortgages is? If you had to venture a guess?
6.5.
6%.
Yeah.
6%. So are we far off from the median? No, not really. And again, if anything, we're trending towards that direction. I'd be thrilled with 6%, right? At this point, because 6% is a good cruising altitude. You know, with all sorts of different type of, you know, relationship-based pricing probably, or shorter-term mortgages, you can get to something more palatable, maybe see something with a 5 in front of it, but we still got a ways to go before we do that. Now, the USD Lusk Kasdan Real Estate Group just released their economic outlook for the foreseeable future. And, you know, they posed the same question, right? And this is, I love this quote because, you know, it's around pain. How much pain is the Fed going to inflict on the economy to force the current 3.5% rate to the target to 2%? And again, even that, like I said, the slides are a bit outdated from a week ago because the more recent economic numbers show that the recession is more in the 2.5% range. But, you know, that's the trick right there, right? That last little bit, that tends to be, even though it seems like this much to go from a rate perspective, those tend to be the longest hurdles to overcome, right? Because it's going to be a slow slog to get to that 2% number, and there's a lot of stuff that can happen to the economy in the meantime.
John, do you think the election next year is going to have an impact?
You know, there's a lot of things that happen leading up to an election, and it's tough, right? I mean, right now, I'd have a stronger opinion about that if I had a clearer idea of, like, you know, who even the candidates are really at this point, right? I mean, we've got an idea, but it seems like that could possibly change. You know, frankly, the Fed is supposed to be immune to political outlooks, but, you know, I think we know the reality is something different. Or certainly that they have to maneuver their economic outlook based on what effect the politics are having on the local economy. So, you know, I don't know if one answer is going to be better than, you know, one regime is going to be better than the other, because I don't have a clear idea of, like, you know, what the economic policy is on either side. It's, you know, I focusing on the inflation figure is really the only thing that you can really be religious about, because that's what the Fed is saying, right? So it doesn't matter who's in office. It's just, you know, how are they going to tackle inflation? You know, I mean, you've got vastly different ideas about that. I think you'll see a lot of things happening leading up to the election.
I agree.
But, you know, in terms of once somebody's in that office, if you look at the slides, it doesn't really change that much. There's a lot of tips and bells and whistles leading up to a particular election point or election cycle, but then after that, it just continues to do its normal thing anyway. Next slide. Okay, so we've talked about rates. And by the way, this is interactive. I talk about this all day long, and it's very boring for me. I'd rather hear from you folks. So please do not be shy about any questions. And again, I have no crystal ball, but I can give you my best gut check from what I've seen over the past couple of decades and a couple of weird cycles. So, yes, sir.
The rates overseas are much lower in Japan.
Could you repeat
I'm sorry.
that?
I'm sorry.
It's a
In
good question.
Japan, overseas countries, much lower.
Well, so it depends on where you go, right? So yeah, so Japan, Japan's an interesting one to bring up because they've been dealing with a hyperinflated economy for quite some time, right? They've had to take some really austere measures, you know, and some crazy things from their Federal Reserve Bank. But if you look at the UK, for example, you know, I would say you can look at the UK almost as an example of, you know, where we could potentially go. I'd say they're a bit further into their inflation journey, right, than we are, right? And they're on the UK is, because of the steps that they have or have not taken, they're in a lot greater danger of a recession than we are, right? And again, that's an odd duck too, because they've removed themselves from the European Union, so they're a lot more insulated than they used to be. So, but, you know, I've got folks that were just traveling in London. You know, the dollar's the strongest it's ever been in comparison to there, and they have a lot of the same concerns. They, you know, their real estate market too does not look that much different from ours. You know, high prices, lower inventory, yep. Yeah, but you know, their rate environment is not too much different from ours. So it just depends on where you go. But I mean, look, thinking broadly, by the way, and again, we'll talk about diversification later on, that helps, right? Foreign markets are certainly an opportunity when the dollar's strong, right? Yes?
I have Marianne O'Donnell again, and I have a question about, there's a new bank, there's a lot of advertisements about it on television, it's called BMO.
BMO, the former, yeah, the former East West Bank. Not East West Bank, sorry, Bank of the West.
Bank of the West.
Mhm.
Okay,
Not a
that's-
fan.
I know. Okay, so that's who they used to be, they changed their name, because I'm seeing like, locations of those banks, new
Yep.
locations of them.
Yeah, they've been there. They were just Bank of the West. So you see, so the new locations are just the Bank of the West locations now that they're putting their signage on. And look, that's a great comment to make because you're going to see a lot of that. Frankly, you're going to get sick of hearing about Flagstar Bank around President's Day weekend, because our bank in particular, we have a genesis of 3 banks coming together, right? So we're going to launch a large branding campaign, but that's not going to be ubiquitous. It's going to be more ubiquitous, right? That's not going to be singular to Flagstar. The players that are left on the playing field, are going to be a lot more aggressive now about letting you know, hey, we're here, right? And that's a good segue into regulations, because the cause for that is a lot of the regulatory environment that we're seeing. So I like to start off with this Wilbur Ross quote, because it's from 1937, but still somehow rings true today. Where banking, I would argue, is the most heavily regulated industry in the world. Regulations don't solve things, supervision solves things, right? I'm not too shy about saying that, my issue with a lot of the financial regulations that have happened even since 2008 is you have financial regulations being passed by non-financial professionals. They're getting a lot of good advice, but what rolls out is being tapered by special interests and constituencies, and at the end, the policy looks a lot different than probably what was proposed by the true economist that was putting it together or advising in the first place. Dodd-Frank is a perfect example when it comes to mortgage lending. If we all recall, when things started to recover, it was still pretty hard to get a mortgage, right? The pendulum had swung so far to the conservative direction, you needed a DNA test practically to get a loan done. And I would say that's not much different if you're in the conforming loanscape. But as we got further away from that, right, lenders got their head around things and they realized that it doesn't have to be so tight, and they can portfolio loans. If they're willing to assume the risk, they can be a bit more flexible with the underwriting. But Dodd-Frank is, again, a perfect example of, the issue with regulation sometimes. After the 2008 fallout, there were still provisions of Dodd-Frank that were rolling out that would change the mortgage landscape and banking requirements and reporting that didn't even really apply anymore because we had moved past it. The recovery had started, people were lending at a fair clip. We weren't seeing these extreme loans being made, irresponsible lending practices that were being made. Banks weren't just requiring a pulse and a credit score. People were taking prudent steps to make sure that the lending was done the right way. But then there were still these provisions that were rolling out that would change things after the fact. So, and I love this from Aaron Bacall. That's what it feels like. Just as recently as this week, it feels like there's a moving truck always dumping more regulations onto our doorstep. Alphabet soup. Speaking of regulations, these are all the wonderful people that I am regulated by and what I do every day. Special bonus points to anybody who can tell me, out of all those many, many acronyms, which one up there is primarily responsible for consumer mortgage lending? Does anybody know? Anybody? You want to take a stab at it?
FHA?
Nope. Who do I have to kowtow to the most?
The deposit, FDIC?
CFPB. That's right. Consumer Financial Protection Bureau. Yep. They are the ones, all roads stop to them in terms of, oh, sorry, it's a little bit small. Yep, that one was small. And it's got a white background too. So yeah, the CFPB, the Consumer Financial Protection Bureau, make sure that they help establish for those of you familiar with the terminology, an NMLS-ID, National Mortgage Lender Service Registry. That again, assigns me an ID number to make sure you can look me up to make sure that I've been above board. Those are all good things, right? But right now, especially in the environment that we find ourselves in, as banks continue to merge and the banking landscape gets smaller, which the Fed was very clear about saying they're perfectly fine with that, more and more people kind of come into the mix. So I'll give you a perfect example. At my previous institution, First Republic, when it was here, we were an FDIC bank, right? Now at Flagstar, I am regulated more by the OCC. I can tell you, in our day-to-day existence, without going into too much stuff to bore you, we're joking about it today. I never thought I would say the words that, boy, I miss the FDIC. But boy, do I miss the FDIC. Because the OCC, they do things a totally different way. And that's the challenge that everybody's experiencing right now, right? Why should those guys be approaching lending different than these guys, but they do. And what they require from a regulatory standpoint and reporting and what they're comfortable with structuring, right? I'll give you a perfect example, right? And again, I'm speaking to personal experience, but right now, Flagstar Bank is an amalgam of 3 banks, right? The parent company is New York Community Bank, which acquired Flagstar Bank at the end of 2022. That was just a normal merger and acquisition. And Flagstar, for those of you who may know, they're actually a large mortgage lender. They're the 8th largest mortgage lender in the country, and the 5th largest mortgage servicer. But they really stick in that conforming realm, right? Where they do more of the smaller dollar mortgages, not so much on the coasts, but in the middle of the country, okay? And then when March Madness happened, New York Community Bank agreed to assume some of the assets of Signature Bank, okay? So Signature Bank, very similar to First Republic Bank, they were basically a large private commercial bank. So they would do private banking, but for large commercial companies. Well, they did things like private equity capital call lines. They did things, certain types of security-backed lending. Well, guess what? We go to do these now, and the OCC says, you can't do those. And we say, why not? We've been doing it forever. They're like, Signature's been doing it forever. Signature doesn't exist anymore. So these are new products. So you can't do these until we give you the blessing. And you have to get board approval, and you have to make sure that these are all structured properly. So these are all the things that banks are contending with right now, right? You have to make sure you live and die by the regulators. And again, I don't know how closely you were following what happened in March. Obviously, I was in the trenches. Everything that came out of the Fed had a direct impact on what was happening with the bank failures. My friends and peers at Signature Bank, it was tough. It was a weekend and they were seized, right? But the Band-Aid was pulled off quickly. Those of us that were at First Republic went through a long, slow, arduous death. And I wouldn't say one's better than the other. It just brings its own kind of PTSD, which I was joking with Danielle earlier, like when I did these slides, a lot of that stuff came to the forefront, but yes.
I think also make this along what you're saying, the point that you're not saying, but I think you're making is why it also matters so much who you go to as a lender, because each individual institution does things very differently, even if it from the outside seems like it should be the same.
Yep, and that's ultimately how I want to tie it all together, right? When we get to the end, it's, you have to, the partnerships that you form right now, especially on the real estate side, are very, very important, because you have to know your lender, you have to trust them, you have to know what their capabilities they are. They have to be transparent with you, okay? We can't all be all things to all people. And even when I was at, again, a bank like First Republic that was very flexible in terms of what it could do, I still couldn't be all things to all people, right? There were other banks that did other things much better than we do, right? And that's still the case, but I would say it's even more so now, because again, the playing field is shrinking. So, if you could, thank you. My best friend, Jenny Yellen. So yes, she was quite front and center during all the events of March Madness, and that goes to the point of what I was saying in terms of everything that came out of that group had a real big impact on what was taking place live and in person. So, Janet Yellen was famously quoted as saying that we have 4,000 banks in the country, which is more banks, relatively speaking, in the United States than almost any country of which I'm aware. And she followed up that statement by saying, I'm fine with mergers and acquisitions. I think we should shrink the playing field. And living in capitalist America, I think the competition is very, very important. And ironically, usually bankers don't find themselves in the same sides as folks like Elizabeth Warren. Elizabeth Warren was probably the most outspoken and said, hey, this attitude towards fast-tracking mergers and acquisitions is seriously detrimental, right? Again, this is a biased opinion, but I think if the Fed had their druthers and we could be like Canada, which has like 4 national banks, and you get to choose one of the 4 and it's the same experience no matter where you go, they would be thrilled with it. They would be thrilled with it. Because you can regulate 4 banks, right? You can regulate 4 banks. No matter how big they are, there's only 4 places that you have to go. Right now, they have to deal with 4,000.
Yeah, that's
okay?
incredible. That's incredible.
It is. But that number continues to shrink. You are going to see a lot of mergers and acquisitions happen in the coming years, right? And even as relatively as big impacts of this is relatively as this week, because right now all the big bankers are on Capitol Hill talking about Basel III, right, which is the current plan that the Fed has to get banks in order. And there's a lot of outcry saying, you guys are being too aggressive with this, you're going to halt business, right? And look, I get banks don't get a lot of good PR, understandably, but it's a necessary tool of the environment like this, and eventually it trickles down to all of us, and people wonder, well, why can't I get a mortgage anymore? Well, when the contagion happened and everybody started pulling their money out and they let banks fail that were giving them those mortgages before, you have to kind of look inward in terms of that. So, I would have people at my desk crying, saying, oh, I love you guys, I want to pull my money out. And I get it, by the way. If I'm standing next to a house on fire and your wheelbarrow full of your cash is sitting there, and I tell you, it's not going to burn, I promise you. And you take my word for it, unless I'm a firefighter, I guess. But, so there's a lot of emotion involved in that sort of thing as well. So it's tough to pin down where it's going to go, but that landscape is going to shrink because the Fed is going to make it very easy. Like, oh, you're a bigger bank, you want to need a smaller bank? You got it. Take it. We're thrilled. We want to lower that. But even some of the investigative practices that the regulators are supposed to be doing, right? By the way, just so you understand, again, using First Republic as an example, the FDIC had offices in our offices. They had people that sat in chairs and were reviewing our portfolio all the time. The question is then, how did those folks not step up earlier and say, I have a question, a concern, how are you guys going to address it? If you read the FDIC report, again, specifically about First Republic Bank, they admit to a fair amount of shortcomings on their end. But how are they addressing that? They're saying they're going to double down and they're going to be more aggressive with surprise inspections and that sort of thing. And does that really fix the problem? Not necessarily. No, what's going to happen is they're going to start to downgrade some banks, right, that may need some propping up, but the downgrading, as we see, once that becomes public information, people start to short those institutions if they're publicly traded, confidence goes out the window, and it becomes a self-perpetuating prophecy.
Yeah, because all banks can't be flourishing and prospering,
You want to know,
like that.
you want to know the sad, sick joke about the whole thing too? The portfolios that the banks were carrying that everybody was so concerned about because they were trading, these bond portfolios were trading at lower rates than what the prevailing rates were in the market. Who forced the banks to purchase those treasuries? That was a requirement of things that came out of 2008. So you were required to hold government securities. So these portfolios that were built at regulator discretion, right, regulator advisement, were the ones that helped tank the banks. And people said, oh, well, they're trading in negatives. That's all true, right? And there were hedging strategies that some of these banks should have taken, First Republic included, frankly. But the fact that they were holding such volatile instruments was a function of what came out of 2008 anyway. So, Johnny Allen, my friend, if we could go to the next one. So, the third R here is reluctance, right? Because when you have rates, high rates, plus aggressive regulations that make it tougher for lending to happen in general, what do you get? You get buyer and seller reluctance, which again, none of this is earth-shaking to all of you. I know you're living it every day, but just, kind of gives you an idea about the psychology behind it. But let's talk about some of the things that are making folks reluctant on top of the rates and regulations, or how those tie together. So I don't know if any people know this show, South Park, but it's, talking about just prices and inventory in general. It's someone coming in, buying a home, and here's a price, here's a house in your price range, and it's gone. Right? I mean, how quickly you all seeing still multiple offers, right? Especially in homes that people can afford, right? Even in the middle luxury space, that's still an actively traded market. And how could that be, right? Wouldn't you think that people now are they're having a hard time raising capital, so they'd be selling homes? Well, not necessarily. So October 23 was record breaking, but not in a good way. And these are our friends at the National Association of Realtors. Sales were down, kind of across the board. But look, regardless of the low sales activity, look at the inventory. It's only 3.5 months, a little bit over 3.5 months. What does that compare to? In October of 2022, when things were still going at a pretty good clip, a really good clip actually, and that's why the inventory was so low. Look at the delta, there's hardly any delta there. So how is it that there's still high inventory in a situation like this? And look at the price. Home prices have increased, and that's across the country. It keeps going up and up and up. So the contract signings for existing homes lag their slowest pace in 2 decades. 20 years we haven't seen that sort of lag in activity. And again, how could that be in an inflationary environment? Well, the problem is that if you sell your home and you're gonna make money on it, but then you wanna borrow money for a new home, do you wanna borrow that at 7.5%, 8%, right? Especially if you wanna stay in the relatively close to where you were before. No, your cost of capital has skyrocketed. So people that were going to sell their homes say, I guess I'm gonna stay put. Especially those folks that have a 3% 30-year mortgage,
Right.
because a lot of us do. A lot of us do. Anybody have an idea of what, prior to now, what the historic average lifespan of a US domestic mortgage is?
5 years.
5 to 7 years.
7,
Yep,
5.
5 to 7 years before either that mortgage gets refinanced or you trade out of that property and upgrade it to something else, right? So my guess is we're gonna see that number increase quite a bit depending on how long the cycle lasts, right? And that hasn't changed for quite some time. You know, you're talking about all the history of mortgages. But people can't upgrade like they used to. So you see here, you know, other things that factor into the lack of sales activity, going back to the regulation side, it's even happening at a state and local level. Everybody here, I assume, is familiar with Measure ULA, right? Okay, so now on top of it, you know, LA has finally instituted, well, a lot of other states have had this, but New York in particular, but now we've got our own mansion tax. But that doesn't stop with single family homes. It applies to multifamily, it applies to commercial, so everybody's getting stuck with a bigger tax bill. Yes?
So, we know that residential is condos, single-family homes, and 1 to 4 units, and that's residential investment. I know that Flagstar also does commercial investment. What are the rates looking at, minimum down payments? But can someone take advantage of the rates for the residential income? How different are they for residential income or single family versus when we get into commercial?
Yeah, great. That's a great question, Monique. So, you know, right now, again, you're sort of looking at what, at least how Flagstar, but a lot of banks too, you know, we're pricing off of short to mid-term treasuries, right? So we'll take a look at the 3, 4, 5-year treasury and then do some sort of spread over that. On the multifamily side, that ranges anywhere from 2.5% to 3%. Now, the kind of en vogue index right now for single family, you know, whether it's a single family primary residence or investment property, it's the SOFR index, SOFR. So it's a spread over SOFR, which again is going to be in that same range, right? So, you know, for investment properties, you know, banks in general, because there's more risk involved, you're not inhabiting the property. You know, there's always a spread. You know, you figure if your standard spread over mortgages, whatever indice that they're using, is in the 2% range for a primary home or maybe even a second home, you're going to add another 50 to 75 basis points on top of that for an investment property, right? Yes.
But Flagstar does commercial properties up to what point? At what price point? Because you have a division for commercial.
Oh,
right?
yeah, there is a division for investor. I mean, you know, the Flagstar, that side of the house has traditionally done very, very large.
And that's why we know that you're experts in that
Yep,
field.
yep.
So.
You know, we'll entertain, you know, frankly, all shapes and sizes. I mean,
Okay.
if you take a look at some of the, you know, parent companies, New York Community Bank, the main holding company of everything that's going to be Flagstar, they were the largest multifamily lender in the country, right? Now, the majority of the portfolio was in New York, but that's where the majority of your multifamily is. But, you know, if you needed multifamily lending, New York Community Bank was a big part of that. Signature Bank did large commercial properties, you know, and these are, you know, middle market businesses that are buying their own, you know, office space, buying their own retail center, you know, and you're talking in the tens of millions at that point. So, yep. You know, and again, those transactions are still happening. It's just at a much slower clip because the cost of capital is so big, right? And when it comes into the residential side, whether it's investment or personal, all the conversations that I'm having with clients right now is it's a means to an end, right? All that you're doing is kind of floating yourself, you're bridging yourself until the rates come down again and you refinance as quickly as you possibly can, right? The nice thing about the investment side, and I was talking about some of this with some folks before we started tonight, is you take the emotion out of it, right? You need an experienced realtor team to tell you this is what your return on investment is going to be. This is your cash flow. You know, get an idea from your lender what you're going to have to pay for the mortgage for X amount of years or months or whatever that's going to be. Cash flow is king. That's what you care about. And then as soon as you can refinance it, and obviously you want to get out of the current mortgage with this, you know, with as little bloodshed as possible, right? So if you can minimize prepays, if you can minimize upfront costs, right? Or maybe, you know, some lenders, what they'll do is, you know, if you offer to if you refinance with them, if you stick with them, you know, there's an incentive for that, whether it's on the rate side or on the cost side, right? But those are all the things that you have to you know, if you enter into an investment property purchase, that's what you want to be sensitive to. And again, whether it's, you know, for personal use or investment use, we're all just kind of treading water right now until you can refinance at a lower rate and trade it to something better. You know, we're expecting a large deluge. Now, when does that happen? My crystal ball says that the Fed doesn't even start considering lowering rates until maybe mid-2024. And if they do, you're talking about, you know, it's gonna go down much slower than it went up, right? Because that's always the way. So they'll go back to the 25 basis point increments, I think. So you're not gonna see a 50 basis point drop unless things are that good or that bad where they say, oh, okay, we really gotta lower. So, did you have oh yes.
Thank you. Hi, it's Mary Ann again. Okay, under what conditions do you see the interest rates ever going down like below 4? Like, is this something that could be a cyclical thing because we got there one time?
So, I think it's probably safe to kiss those 4% rate goodbye, right? I think the reality will be, you know, the new watermark or the new, you know, low watermark will be, you know, in the 5 to 6% range. Again, barring anything crazy. And look, there are so many times when, you know, over the years, when like rates are going to go up, rates are going to go up, rates are going to go up, and all that they kept going down to numbers that I could never even imagine. But, you know, again, these were all tied to these like strange incidences. But the problem is every time that we raise them again, it establishes a new, you know, a kind of new foundation. So, and this has happened so quickly, you know, where does it land again? I think it lands more to like the medians. You know, could we see something with a 4 in front of it? We're a ways off from that, right? We have, you know, the economy has to be, you know, so good, you know, or things are so bad to let it go down again, they have to stimulate stuff. You know, I think that the Fed will be very happy to say, we've got inflation at 2%, you know, rates are at an affordable 5 to 6% range so people can start to transact in real estate again, and we're cool with this. Let's just see how this goes for a while. But, you know, when we get there, when the Fed says we're at 2% inflation, it's just, that's how it's gotta be. Or again, they have inflicted, as you saw in the previous slide, they've inflicted so much pain on the economy that someone comes to them and says, guys, this ain't working, right? And you can make the same argument that's what people were saying to them when they were saying, hey, you have to raise rates. And they were asleep at the wheel. So again, you know, it's the old hindsight is 2020. And even with recessionary stuff, again, you don't call that until you're in it, until you've been in it for a little bit. It's all backward. Thank you. And this is a vicious cycle, right? You know, we've got, you know, high rates, and you can throw in the regulations into that, and then, you know, fun stuff like Measure ULA on top of it, right? Extra taxes. You've got diminished seller appetite, which leads to low inventory because no one wants to sell their home, right? Even though they could get a good clip for it, unless they're going to completely retire and move someplace really, really cheap. The trade-off isn't worth it for them, right? You'll stay in your home, you'll make it nicer, and then you wait for the next cycle. You wait for things to get better and sell it hopefully for the same price, if not better. Because as we see, the prices keep going up. As long as the inventory stays low, the prices are going to keep going up. And again, so, you know, it all self-perpetuates.
John?
So, yes?
I just had a question. Has there been a time in our history where everyone was doing good, right? People had money to buy things, they had income, and there was stuff to buy, and it was just like a nice playing field where everyone, you know, could have the American dream. It seems like now it's going further and further out of grasp for people. Things are more expensive, or they're not available to buy, and people have less money. And it just seems that creates all this manipulation of things. So I'm just trying to understand, is there a scenario, unless I'm crazy, of like everyone having a chance, so you have, you know, people working, people making money, people being able to afford things, and things being able to be purchased because they're there. Anyways, I'll stop.
No, it's a great question, and it's tough to pinpoint exactly. Yeah. I would say I'm not fully qualified to answer the question, frankly. But I can tell you sometimes that we're more along those lines, right? As crazy as it sounds, I mean, those of us that remember like the late 80s, where interest rates were in the double digits. But here's the trade-off with that. Yeah, you're borrowing a mortgage at like 16%, but you were making 18% on your retirement assets, right? That's the other side of this coin, right? The rates are high from a borrowing perspective, certainly higher than we've seen in quite some time. And yes, now you're starting to make some money on your liquid cash because banks have to give you that interest because that's what the Fed is charging them. So there's starting to be some parity there, but things are still so much more expensive than they were in the 80s, right? So yeah, your 5% on a CD doesn't buy you the same as what an 18% CD, right? And then when people go into the retirement stage, their money's been making money that whole time. Hasn't been the same. We've had all these, peaks and troughs. So it's tough, you have to time it. And, you've got a lot of folks there that are working way past retirement age because they said, well, I was ready to retire. I mean, I can tell you that happened with, it becomes insulated on a micro level, right? Folks, that were caught up in the banking crisis, people that worked in administrative roles for a long time and probably had all these RSUs in the institutions that they served for decades. Well, all of a sudden, overnight, unless you diversified out of it, and all those stock, you said, oh, I'm gonna let it ride until I retire because I got the stock at $20 and now it's $100 and now it's 25 cents. So what happens to that person, right? Do they re-enter the job force or do they retire and now all these transactions that they could have had to contribute to the economy, that goes away. That goes away. So, but here's the good news, and this was to Danielle's point earlier, right? About tying all these things together. Look, I am a firm believer in that this is just another cycle like everything else. What goes up must come down, right? And we were up so long, I guess we were down so long, right, that the rates had to come up. It's just what's so tough about this one is that it happens so fast. So while it's like this, how do you navigate? Well, the good news is lenders are still lending. I still have capital to give to you and to your clients, right? You just have to be realistic about it. It's going to be more expensive, right? It might make sense for somebody to pay points, right, to help bring down the rates. And in that case, those are things that maybe you can negotiate and offset with seller credits, right? And to Danielle's point as well, you have to make sure that your lender is transparent with you about what they can and can't do, right? The Fed has paused for now, at least, the rate hikes, right? Could there be more? Sure, but at least it ain't getting worse for the moment. So, and the longer that stays that way, the more the optimism builds, right? And the more they kind of look back and say, how much damage have we done, right? And that's always the way that this works. They have to go, and then they stop and look backwards and say, are we at the stage yet where we can? They're not comfortable yet, but at least they've stopped. Because we had predicted rate hikes going out all the way to the end of this year. So it's better that that modeling has changed. And again, recession doesn't help anybody, right? Doesn't help anybody, and that seems, again, by the numbers, very unlikely. It's a little bit of a double-edged sword though, because without the recession concerns, the Fed's fine cruising along and doing what they're doing for longer. They don't have a gun to their head. Make sure that you've got your A team, right? Realtor partners that know your target markets. They can talk to you about return on investment, because again, this is all about investment property. So take the emotion out of it. Know what you're getting back in terms of cash flow. Know what the opportunities are in terms of how you can exchange out of it and defer those taxes, where your break points are, okay? You wanna make sure that look, I'd love to be everything for everybody, but I tell realtor partners too, like, just keep me in your bag of tricks. I'm one option, but I'm sure you have others and you should. Because I'm not always gonna, sometimes maybe hard money's the way to go, right? Or I might have certain interesting loan programs that somebody else doesn't. And also cash is really good to have. That's okay, nothing too big. I forget what the third column, oh, yes. Managing expectations is important, right? There are opportunities in every environment. It's just that, again, that last bullet point, if you have access to investor partners with capital, cash is king. And we are at that stage right now, right? You always hear it, and you always wonder, at what point in the market does cash matter? It matters now. Now is when it matters, right?
No, I had 3 deals recently, all cash.
All cash.
It was like,
Somebody walking in with a suitcase full of cash, because even the sellers too, the nervous sellers, they don't want to deal with anybody who could have a loan blow up on them, and they do. And now is the time when they do, because someone that qualified, this is one thing I didn't illustrate in the slides, but just think about the basic math. Think about what you were paying for a mortgage, a 30-year mortgage, a straight line amortization over 30 years at 3%, and now take that rate and increase it to 7% on $1 million. Do you know what that does to the payment?
a lot.
$3,000?
Yeah, more like 4,
Yikes.
right? Yep,
Yeah.
more like 4. And remember, the interest compounds. So compounding interest at 7% is way bigger than at 3%, right? Because you see on loan estimates, like, if you hold this loan to maturity, this is the interest that you're going to pay by the end of the loan. Well, that number at the end looks way different at 7% than it does at 3%. So, and people have to take that into account, right? now more than ever, the conversations that I have with borrowers, because people are still fixated on 30 years. It's like 30 years is cool when you can get 3, 4, 5% even on it. Now, why on earth would you entertain a 30-year mortgage? Why? The bank, in good times and bad times, the lender's always going to charge a premium for you to lock up that rate for the longest. Why pay the bank more money? Why? Again, we're all just treading water. I don't need you to pay a higher interest rate. It doesn't do me any good, right? I want you to borrow in the most comfortable way possible, right? And again, when you trade out that note, you just want to make sure it's as less painful as possible. Do your research on where you're buying, expand to other markets, right? We all love California. It's a great place to be, but it's kind of expensive. And for investment purposes, student housing is great. There are always students, and student housing in Oklahoma is going to be a lot cheaper than it is here, than at USC. Be patient, right? You have to understand that it's there's a lot of romancing that happens now. And again, you folks know better than anything, how that goes. And then be prepared, right? Be prepared with documentation. The joke that I've always been making, it's, death by 1,000 paper cuts since Dodd-Frank. It's probably more like 2,000 paper cuts now, depending on the type of mortgage that you have to get, and what you may have to continue to present. Be prepared for counteroffers, and be prepared for time-sensitive buying events where you can just jump on something. And these are all the conversations that we're having with clients right now. And that's, leading to the rates. Again, the rates are going to do what they're going to do. They come down a little bit, that's great news, but we've still got some time before they come down to something where we'd like to see them. So, what do you do in the meantime? You just understand that if you can inject more capital into it and pay the bank less, that's the way to go. Always. Yes, sir.
Would you recommend adjustable in this market?
Absolutely, no question about it. Yeah, again, why would you do, if I can give you a 5-year, it's still a 30-year mortgage technically, but if I lock the rate for 5 years and save you, I don't know, a whole %, why would you pay me 1% more for 30 years when you know you're gonna refinance that? Yeah. Even, by the way, again, remember what I said, statistically, the average lifespan of a US mortgage is 5 to 7 years. Even if it wasn't this high rate cycle, in 5 years, that mortgage wouldn't even exist.
Okay. I had loans which were Lego, disappeared. They said, no more Lego. Now it's, I think, Treasury Index.
It could be Treasury, it could be SOFR. They might be using the SOFR index. Yep.
Bank to bank, one bank is so aggressive, within last year or so, they have raised 5% my mortgage, 5%. Another one raised it about 2-3%. I mean, you're saying everything is regulatory, but what is regulatory?
I mean, so regulations make it tougher for us to extend certain types of mortgages, but in terms of a mortgage that you've already got in the books, yeah, I mean, once you let that rate go adjusting, and in a high interest rate environment, that's the danger of an adjustable rate mortgage, right?
But don't they follow the same regulation?
Well,
they're
it's
all Treasury Index?
Sure, but not necessarily. So regulations are different than what's in the note of your mortgage, right? If you're based on a certain, if it's based on a certain index, right? The banks have to play a lot of catch up, right? Because like I was mentioning, they've collected, sub 3% on their treasury portfolio, but yet they're, they lent money out less than that, and now they're paying on the deposits way above that, so they got to play catch up. So if you're an adjustable rate mortgage and they can raise you to a certain amount, oh yeah, they're going to jump as high as they can. Yeah, you don't want to stay. Now, if you start the clock on an adjustable rate mortgage today, that's fine because yeah, in 5-7 years you're going to refinance that loan. So, but yeah, it was, to Barry's point, if you had an adjustable rate mortgage that adjusted at the end of 2008, you were in a great spot because your rate dropped way low. If it adjusts now, so Barry, you should talk to somebody about refinancing your notes. But then you should refinance. What kind of properties? Okay, so I mean, commercial's a little tougher. Yeah, of course.
We didn't finish the final slide, did we?
No, the final slide was just thank you. So, thank you.
Well,
No,
this is, Joe, you needed to next
I'm right up on
video.
Wilshire, I'm Bedford, 9665 building. So that has a Woodland Rose address, I go back and forth, but that's.
Oh, we're recording this, so.
Oh!
Yeah.
Sorry.
We want to thank you, thank you for coming. Okay, And we know time is short. Joe, do you want to separate? Thank you, John Durante.
Yes,
We've
thank
been
you, John.
so lucky to have you be part of our team. And we recommend you to any of our clients and love your expertise and so happy that you made a smart new move. Joe is just gonna set up the next slide. We're gonna make our presentation brief. But we want to thank all of you on Instagram. We actually had about, at some point, about 40 people watching at once on Instagram. And so it was great, and this will also be on YouTube. But I wanted to just say thank you, Joe. Here's the slide, and I'll make my presentation brief, but I do have a few messages for you, questions. So with 1031s, if anyone wants to get a copy of any of these slides, just email us, and our contact is at the end. And this isn't working, so I'll just let Joe, I'll do the presentation and just let Joe be the operator. Thanks, Joe.
You're welcome.
So this is us, we're Monique and Joe Carrabba, we're at Compass, Beverly Hills. We love what we do, we've been doing it as a husband and wife for 15 years, and we love working with primarily residential income. We have a few other agents in here that we are close with, so I recommend anyone at Compass. If you're looking for someone that does residential property, we have a plethora of people all over the United States. And we're just happy to host these professionals. So believe it or not, what I've heard from Phil Ashwan, who actually couldn't make it today, is that the average time when he believes that a loan needs to be turned over when it becomes principal only is 12 years. So that might more than 12, Joe?
No, more principal than interest.
So that I'm going to give you a little to change the slide every time since we're having a little mechanical difficulties. So I'll make this short and sweet. So what we want to do is talk to you about how to make your 1031 dollar go quicker. And Paul, I just have some brief questions for you on that. Ways to make your 1031 exchange proceeds go further. So, all right, purchase a replacement rental property locally. That can be anything from a commercial property to a house with an ADU. Now remember, in Los Angeles, once a single family home has an ADU, it's under rent control and it becomes basically a duplex. Both properties are residential income. So keep that in mind, and you can also purchase a commercial property, and we're more than happy to have John help you or assist and see if it's a fit for a loan. The other options that we have on 1031 exchange options, and this is where, Paul, I need your expertise on this. So Delaware statutory trusts, might you be able to explain it briefly? Basically, we know that up to 499 investors can speak on this, but I believe that you are the expert in this. And I would love if you could just briefly let the audience know what exactly that is. And we have another slide as an example of this.
A DST is what's called a Delaware statutory trust. And it replaced the old tenancy in common relations, where real estate agents would get a bunch of investors in to purchase property, usually pretty valuable property, and they had their problems with that. So the DST came along, the Delaware Statutory Trust. You have companies that are called sponsors, and what they do is that they go out and they target a property that they will acquire, and then they will sell trust interest in the property. And it really is a better product than the old tenancy in common thing, because with the old product, the people who bought into it were personally liable for the loans and for other things and making decisions regarding the property. But to get into a DST, you have to go to a financial advisor who has a license with the Security and Exchange Commission, okay? You can't go through a real estate agent.
And what about John, a bank? No, not either?
Not necessarily. Well, you really need a trust officer that has powers in Delaware. So for example, again, not to invoke the past, but we would, at First Republic, we would establish Delaware trusts for certain transactions like this, right?
Right.
It's also become, as a separate conversation, but Wyoming trusts, right? We established an arm of the bank in Wyoming as well to make sure that they handle Wyoming trusts to take advantage of situations like this. But yeah, but a bank's trust department may be able to help.
Yeah, and these companies put these people together. They do form separate trusts for each of their investors, and it comes under this portfolio. There's a net lease agreement on the property. Yeah, and you have to be qualified in order to get into one of these. And I think right now it's at least you have to have $1 million of assets, excluding your primary residence, or a certain amount of income.
And then the next slide, I want to go over just types of examples of DST investment properties.
They buy almost everything that, as far as I
Everything
know,
on the
that's on this
board.
list. They'll, the apartments are very popular right now. They'll go down to Texas and they'll buy a 600 unit multi residential property. They do all of these. The assisted living is very popular, medical office, industrial hotels. Hotels have been very popular. Oil and gas, probably not so much. Offices, they're staying away from because of the vacancy rates. I have no idea what a zero coupon is.
I do have a question. With the manager of this DST, I had personal experience with a DST with my family, and they were always at a net. They were bamboozled into having always a loss on the property because of
Really?
maintenance. Yes.
Oh,
So
that's surprising.
So does Exchange Resources have like vetted people that they can connect them to?
We have financial advisors that we have worked with over the years that
Okay.
we have, and we tell all of our clients, look, we can give you 3 names of people that you can go to,
Okay.
but you have to get your own advisors in there to decide if this is the right investment for you. And a lot of times the sponsor will fly people out to Michigan or to Arkansas to take a look at these properties. But they kind of have to decide for themselves what's best.
Is DST almost like REITs?
What did you say?
Like a REIT.
It's like a real estate investment trust.
Yes.
With the real estate investment trust, that's like a mutual fund. And there's a bunch of them out there. What they do is that they go out and they buy these properties and then they sell shares, stock shares in the REIT. You cannot do a 1031 exchange with a REIT interest because what you get from the REIT is a stock certificate. And a stock certificate, as I said before, you cannot exchange stock certificates.
It's real estate.
Real property.
But even though it used to be 100% of the REIT had to be invested in real estate, that's not the case anymore. But primarily, they own real estate. But then if you went in and you went to this, I'm trying to think of the name of one of the REITs, you would get a stock certificate as if you went to Fidelity, for example, and you bought into their stocks and bonds. They would give you a mutual fund. It's a mutual fund. There are instances, however, where the REIT will drop down one of their properties and they will sell that property to individual investors through a financial advisor, and that's called a down REIT. And so they'll sell it out, they'll give them title to the property, and then within a year or two, they will bring that property back up into the REIT, and then they will convert your interest in the real estate, and you'll get shares in stock. And that does not cause a capital tax, capital gains event. It's very tricky, but a lot of people do it to get involved in real estate, but at the end, and a lot of elderly people are doing it because they want to be able to give shares of stock to their kids instead of, you have 10 kids and each kid is getting 1/10 interest in this property and they go crazy.
Yeah.
Thank you.
Any other questions? I think we just have a few other options, and thank you everyone for coming. So take a property and convert it into to a short-term vacation rental locally, that's one option, pretty clear cut. I know a lot of friends that have Airbnbs. This is my assistant, Brixton, and I just want to introduce him because he's been so patiently helping us set this up tonight. And I thank everyone on Instagram and that's been watching. I thank everyone for attending, and the vendors that provided great hors d'oeuvres. So the final option, Joe, is consider, and that's where the remaining agents in the audience are. Let me just go off. Just say.
Mary Ann O'Donnell, Compass.
Jimmy Martinez, Compass.
And we've got Monique and Joe Carrabba, Compass. And so we're really here for you to make you all know that Compass has a huge amount of space in the most desirable metropolitan areas. My husband Joe is from Houston. There are a lot of people investing in Houston and also resided in Austin. So here's a list of cities and states, many of them places like Aspen, that we have offices. So if any of you are looking for an agent to refer you to a professional to reinvest your 1031 exchange, please reach out to us or one of the professionals that have attended the session, or any other Compass agent that you might have already had a relationship with. But our reach is huge. And as I want to just say thank you, come on Joe, come on up and just change the slide one more time. Yeah, any questions? And if you'd like a copy of this presentation, simply text or call 323-899-2900. It's really easy to remember. Our email is Carrabba, like the restaurant, Mojo, M-O for Monique, J-O-E, at Carrabba, 2 R's and 2 E's, group.com. And we're happy to send you a copy of this presentation. Thank you so much for everyone.
Thanks everyone for coming.
Have a great day.
Wow. That was not easy.
Yeah, that was.
Pulling all this
Not
together,
easy.
you guys
Good.
are awesome.
It's the first time I've
Oh
done
my
it.
God.
I think
It
we're gonna have
was,
serious FOMO.
So I'm gonna make sure this goes on like YouTube and some hashtags.
So great,
and-
thank you.
Oh
Thank
my
you.
goodness,
for having
thank
me.
you,
Thank you so
you.
much. So you had a good turnout online, that's great.
Oh my gosh, it was
That's great. People reacting?
it was
I
great.
don't think we
And I
were,
mean,
we were
I
getting,
thank
we
you-
weren't
I
getting
thank
questions.
both of you for your support.
That's
I
cool as long
really-
as they're watching and they're tuning in, right? I mean,